Hey everyone, welcome to vlog number 14 of Lake Effect Investments. It's been a long time since I've done one of these, and I think the last time that we pulled up as a group was also about a good few months ago. So a good time to check back in, and kind of going forward from here on, I'm just going to kind of keep these pretty closed loop to a few select people in the LEI group as well as a few other individuals. So let's get started and take a look at what's going on. As well as continue our story, which started back in August of 2024. But first of all, um, the usual disclaimers. So nothing here is about financial advice. This is strictly for discussion and analysis purposes only. And also, please do not share this around for now. I have gone ahead and done my initial licensing and certification, so I've got a Series 65 license now, but still got quite a few ways to go before everything is done: registration, compliance, legal work, and maybe I get an investment advisory set up sometime later in the year. But anyways, lots of exciting stuff going on. Let's go ahead and do a quick recap. So, as I've talked before, the niche strategy that we're working over here is high growth, which is also considered high risk. So, small cap, early life companies, um, from startup to early life, especially in the AI, energy, battery electric vehicles, biomed, and pharma areas. All of these are considered high risk and high growth. And the idea is that we can mitigate those risks by doing some diversification across some of these stocks and sectors, do robust analysis and assessment, and try and get a buy-in entry point, um, which will mitigate the downside risk, right? So as I've talked before, buying a stock, a small cap stock at a 1 year high or a 2 year high is a very different story versus buying one that's on a 1 year low, a 2 year low, but you still think that it has the fundamentals to recover. So maybe that's how we try and beat the market and build out our own moat. But anyways, the long-term hold is also another way to mitigate it. So, you may get favorable quarterly results, unfavorable quarterly results, and that keeps on happening with these stocks. But if you can stick it out for the long term, hopefully with the fundamentals and the low entry point, as well as no leverage in borrowing, you can come out on top, right? So far, the strategy worked very well in 2025. We did about 63% or so. Our big winners were quantum computers, QBTS, that's D-Wave. By the way, that sector is really heating up again. Apparently, the Trump administration is coming out with a sort of a support sponsorship package for quantum computers in its race with China. So we can get ahead and get our security systems updated, as well as use quantum computers for other benefits, I guess, before China gets there. And there's a lot of narratives and hype about quantum computers are going to be able to de-encrypt the internet by maybe 2029, 2028. Who knows? There's a bunch of different speculations out there. Um, so that sector is definitely pretty hot. We did, I think, like something like what was it, plus 300% on QBTS, not plus 243%. So these were the big winners. Navitas Semiconductor, Butterfly, ARDX was mild, was pretty soft, and then we had some losers as well. Bio-Nanogenomics, ChargePoint, that's EV charging, and Blink Charging, that's also EV charging. So the EV market, the EV sector really tanked, as after the early adoption wave, we've kind of plateaued at sort of an 8% market share, EV market share, that's BEV, battery electric vehicles, um, as a percentage of the entire auto industry in the US. So that is probably gonna re-spike and re-engage in its momentum at some point down the road. So far, government is not very friendly in this area, but China, Europe, all around the world, the trend is really taken off. The US is pretty behind in this area. So I do think that that's definitely worth keeping an eye on for the future. So we, this is the previous performance. I'm not going to spend too much time over here. Let's move on and see what's going on now. But we beat the major indices: Nasdaq, Max 7, S&P 500, the Dow. I've got some analyzed numbers over here because we're now 640 days into this portfolio, which was started back in August 2024. And some current positions aren't doing so well. They're kind of in the negative, but it's fine. These are long-term investments, and you're going to get these bumps along the way. And we are mostly sort of in U.S. Treasuries. So most of our position is in cash right now, which is kind of what I discussed, I think, in the previous call that we had, is that this is kind of a wait and see. Well, that was the idea back then, was to basically kind of wait for a correction, and that so far has not happened. In fact, the market, and especially the tech market, is just picking up more and more momentum. But anyways, a correction could still happen. So the strategy is, it's still viable, and it's kind of in sync with what Berkshire Hathaway is doing right now as well. They have about $400 billion of cash, which is, I think, about 30 to 40% of their total AUMs or something. So anyways, the idea is to kind of invest along the same strategy, but a bit softer than before. And hopefully we can get a dip in the market where we can scoop up some more AI and tech stocks on our watch list. That might happen down the road. And I'll talk about these guys more in a bit. But because we have, this is 4% full year. So far 5 months, I'm just going to mark this as about 2% or so. That is going to cause a drag on the portfolio. And so right now, we're coming down. We're now already down to 60%. And as time goes by, as the days keep notching up, this drag is going to increase, but it's just fine. We're still doing very, very well, and we're still beating most of these guys, although they're starting to catch up. But anyways, so much for that. Yeah, let's go ahead and talk about what's going on overall with macros and the economy and the indices. So we are in a scenario of further heightened elevated momentum as well as risk, but so far the momentum is beating out the risk, right? Higher geopolitical risk because of the Iran war, inflation's coming back. There's somewhat softer fundamentals around macros that I'll touch upon real quick. But the hyperscaling investments, ASML, which is a major Dutch manufacturer of hard materials that go into chip manufacturing, they're restating their revenues and forecasts higher for 2026. All this stuff is driven by higher demand, and then AI adoption and AI business narratives, especially around agentic AI, and corporate adoption is also pretty hot, and it's looking strong. So, and then on top of that, the economy is very resilient. So we actually, from this point on, which is kind of where we last checked in, stuff has just moved north, right? If you look at the S&P, it's plus 12%, just over about a 5-month period. Nasdaq even better. The Magnificent Seven, definitely a very heightened level of valuations there, so they didn't climb up that much. But there was definitely a big dip and a huge recovery, which has been the story. Every time there's a correction, there's a dip, or there's some kind of a fear factor that takes over, the recovery is always very strong. But if you look at certain tier two, I call them tier two, tier three companies. Maybe tier two are the Broadcoms and the Qualcomms and the super microcomputers and stuff. But if you add CoreWeave and Nebius and SanDisk and Seagate, so these two are memory, that's basically AI memory, and these two kind of in a nutshell is AI compute. These guys have actually increased 378% over the same period, all right? So pretty significant uptick. And it's all driven by demand and shortage and backlogs of huge contracts. So every time these announcements and deals and forward-looking statements keep coming out, the catalyst just pushes the stock prices higher and higher. And yeah, so that's kind of the markets recap. If we take a look at the economic side of things, so corporate earnings was one huge catalyst on the appreciation in the stock market. And most, I think, what is it, 89% of the S&P 500 companies beat their targets for the first quarter. Unemployment is fine. Anything below 5% is fine. There has not been a huge uptick. And that's basically part of the economy being super resilient narrative. Inflation definitely is ticking up. And a lot of the narratives coming out of the Federal Reserve meetings and the Federal Open Market Committee meetings has to do with that we cannot have any more realistic expectations of rate cuts this year. And in fact, if inflation continues this trajectory, we could even see a rate increase, which I think is unlikely because there will be a lot of political pressure around it. But there may not be rate cuts, and maybe the Fed's just kind of willing to live with a more elevated level of inflation. Anyways, and then GDP also is doing pretty good. These are the estimates. So this first quarter 26 is an estimate, early estimate, and as kind of expected, the biggest driver of GDP growth is now these massive AI hyperscaler data center investments, right? So out of all of the components of GDP, that's that's really the biggest one. And it's taken over, and it's probably going to stay at that elevated level, I would say, through 2026. So it's a bit of a change in the dynamics and how GDP works and how the economic engine works. Not so much driven by the growth, at least, not so much driven by personal consumption as it is by these huge hyperscaling data center investments. So we take a quick look at the leading indicators here. So that was lagging indicators. This is all stuff in the past. Where do we go? Yeah, this is all lagging indicators, right? These are all just reports coming out with stuff that happened a while back. So what can we look at to see what's coming down the road? As I've talked before, U.S. auto loan delinquencies is a good indicator of where the consumer is at and what's going on. And if delinquencies really start to uptick, especially in autos and mortgages, before stuff like credit cards and clean loans, that's when the consumer is going to pull back harder because you're going to protect your car. If you're getting a cash crunch, if there's economic stress, the areas that you protect the most is going to be your home and your car. And if these start to go up, if these delinquencies and defaults start to go up, usually is a pretty solid indication of there's trouble ahead. But everything is pretty much within safe zone, right? It can change quickly, but so far it's okay. Producer price index, the one down here in the bottom left corner, is also an early indicator of inflation. So this is a producer, kind of a raw materials price reading, which then translates into pricing for sold goods to consumers. So if this is ticking up, it usually means that inflation is going to tick up for the end consumer as well. So this is spiking. This one in the middle over here is a pretty good one. So this is non-accrual loans by the big four banking financial institutions: JP Morgan Chase, Wells, Citi, and Bank of America. And non-accrual is basically your bad loans. These are the loans that stop accruing for interest and income, usually when they're past 90 days of default. And actually, if you compare 2Q26 to 1Q25, the levels have actually overall improved, right? So it's um, so slightly lower here for Bank of America, but slightly higher for Citi, slightly higher for the others as well. So maybe not so, not that they've improved so much, but they haven't deteriorated, and they're still in a really good spot. So I think like if you If you take a look at the percentage, yeah, I can't really take a look at the percentage here because we don't have the total loan volumes. All right. Here's also a big story on the economic front. So Treasury yields are really spiking, which means that debt is getting, kind of means that debt is getting riskier. You're going to have now higher mortgage rates. That industry, that sector is hurting right now. I wouldn't, maybe not hurting, but not growing, pretty tepid. Not much going on over there because high interest rates is definitely not good for mortgage lending. We have the 30-year Treasury, which has gone over 5% now, and that is a 20-year high. So you're going to get higher rates on long-term loans and mortgage loans. You've got the national debt that's now crossed 39 billion and trillion, and then I'm sure it's heading for 40 trillion. And the reason that these treasury yields are spiking as well is that there's expectation of further inflation down the road, which may mean no rate cuts in the short-term future, and possibly even a rate hike further down the road. Or I'll just skip this one. This is a technical analysis about bull and bear markets. So we are in a very extended bull market run. It's 1,311 days now. It's beating medians and averages throughout history, but the technical analysis is not going to matter a whole lot as long as there's all this investment optimism, strong corporate earnings, huge capital expenditures by hyperscalers. So, you know, I wouldn't put too much stock into this right now. It's something that can come back into the narrative. I think once we do see some kind of a leveling off or a softening correction type situation, but not really much of a player right now. Okay, so just to do a quick recap on that side, and then we can kind of take a look at the stocks real quick, and I can keep this down to a promised 20 minutes or something. Promise to myself. So yeah, elevated momentum, corporate earnings, AI deployment, adoption, and scaling. Lots of narratives, news, and looks like pretty solid stuff coming out in that area. So it is supporting the momentum. It's adding to it. Very elevated levels of capital expenditure. Record-breaking IPOs are coming up for SpaceX and OpenAI. So that's gonna definitely play into it and add into the all the investor optimism. And the economy is still resilient, right? This is a really big one. I mean, NVIDIA just posted blockbuster corporate earnings of 81.6 billion for the first quarter of 26, and I think it's something like I don't know, plus 40% versus 1Q25, and still very, very high rates of growth, which are continuing quarter after quarter, and now year after year. Yeah, risk is elevated too. The whole geopolitical situation, the inflation thing, treasury yields, national debt, and then there is some economic pressure, especially on the low-end consumer. So you've got the mass affluent who are doing very well from their crypto investments and their stock market investments and their 401ks. But you do have a certain sector of the economy, I guess, at the lower end, close to blue collar wage workers, which is getting more and more pressured. So if consumer spending has a hard pullback, it could offset all the benefits that we're seeing from the hyperscaling investments, but it doesn't look like it. So far, this guy is on top and this guy is lower, right? The market just keeps going up and up. You get all these catalysts, and it just spurs more optimism and more investment. You would think that this stuff is already priced in with the very high levels of valuations and the ratios around price to earnings and price to sales that we're seeing. But so far, the optimism and momentum is beating out any pessimism or skepticism. Okay, so let's move on to what are we going to do in this situation, right? So because we're kind of sitting out of the AI race for the moment until a more acceptable opportunity appears over there. Um, God knows when that's going to be. Keeping an eye on the battery electric vehicle sector as well as energy, right? Energy is a big one as well, in terms of all the extra wattage that's going to be gigawattage that's going to be required to power these hyperscaled AI data centers. Also let's accept some healthy criticism. As far as these guys go, which is where to go? All right, here. You know, it wasn't too obvious that these guys are gonna scale up the way that they have. Their valuations are definitely on very high multiples, but they do have some pretty solid activity behind that too. Maybe the one that was sticking out more as an acceptable risk about I would say 6 months ago would be Nebius, because they're building AI data centers, but they're doing more than compute. They're doing training runs, inference, compute, and some other stuff. And they've got a sort of a broader platform built out for AI, versus somebody like CoreV, which is just pure compute. SanDisk and Seagate were kind of memory and chips related, and as that kind of came into the spotlight, they really skyrocketed. But it was more difficult to predict that memory and chip pricing is going to go up and the demand is going to soar the way it did. But still, definitely, since we are sitting at pretty elevated levels. It still wasn't an easy call, but let's go ahead and accept some healthy criticism. And now I think with the way valuations are, makes it definitely a harder case to buy in at this point. So we're going to sit out of there for better or for worse for now. And let's see where else we can find some opportunity, because we don't want to completely sit out of the market either, being equities people. And let's see where we can find some acceptable risks. So we're going to look at pharma, and this is where I'm taking the positions. First one is Akebia Therapeutics. Akebia Therapeutics, so following our strategy of multi-year lows, it is at a low pricing. It has good income statement and balance sheet fundamentals. As you can see, pretty nice elevated levels of cash that can see them through multiple quarters. They did have even positive, well, I don't know, yeah, on a quarterly basis, they've had positive net income before. And they're getting some criticism from analysts for having kind of dipped back down into the red. But they're spending on R&D, research and development for their drug pipeline. So they think that with their levels of cash, probably what they're thinking is that they can go ahead and do that for a bit more and kind of move their phase one pharmaceuticals research and development further down the pipe. So the reason behind the big fall is over here, is that they have a legacy drug called Orixia, if I'm pronouncing that correctly. So this is all kidney disease related, and that drug was launched a couple of years ago, and it did very well in the market. But with the U.S. pharmaceutical industry and system, you get exclusivity to sell the drug, so you can be the only one selling the drug once you developed it, since you did all the R&D and D and the hard work to get it to market. But that exclusivity will expire in a couple of years, and that's where generics come into the marketplace, and then they undercut the drug, the legacy drug, with pricing, with distribution, etc., etc. So as you can see, Orixia revenue is naturally going to fall as generics hit the market. But Vefseo is their newer drug, which is pretty promising. It's getting good scientific reviews and good feedback from the medical community, and it's making some pretty good traction. As you can see over here, there's some quarterly dips, but we can't trust too much quarterly movements because there's a lot of stuff going on. There's inventory management and write-downs and contracting and realization of revenue. So sometimes quarterly numbers can be misleading. But it did post its highest revenue in the recent quarter. But the story over here is that, can Vefseo ramp up fast enough to offset Orixia erosion, and can it even improve the revenue? So given that equation, it's suffering some distress in the pricing, which in my opinion is not fundamentally sound, because I think the company has a really good track record, has pretty solid fundamentals. Its PS ratio, that's price to sales ratio, is now at a pretty much at a close to an all-time low. Its valuation is down to 284 million. I think it used to be close to about $1 billion or so, I think, at these levels. So it's at a stress level, and I think going forward, over the long term, it's going to depend on how Vefseo does and if Orixia can be sticky enough. So in kidney disease, and in the medical system, it's not always straightforward for generics to hit the market. I've probably gone way over time limit, guys. Sorry, I just got one more stock to cover, so we'll wrap up quickly. Yeah, so it can be sticky coming down, because there's contracts, there's protocols, there's a bunch of dynamics that go on. So it's not like a generic can hit the market and it can erode the legacy drug very quickly. There's going to be up and downs and bumps, and it's going to be sticky. So the play here is that if Orixia erosion can be sticky enough and Vefseo growth can be quick enough, to offset that. And if we get those trends moving in the right direction, usually upside is pretty good. And I wouldn't be surprised if that does come in, that play, that it does like plus 100% from here. So it almost doubles in price. But if it goes the other way, if the risk scenario materializes, so let's say Orixia erosion is pretty swift and Vefseo doesn't ramp up quickly enough, hopefully the downside won't be that bad, because it seems to be kind of priced in right now at the distress level. So I think that makes it a good risk at this point. The other one is T-Scan Therapeutics, which is much early in the sort of the life stage, its overall life stage. It has actually no drug in the market at the moment. It's doing some R&D revenue. As you can see, cash burn is pretty high. It's burning about a good $20 to $30 million a quarter, but it does have a significant amount of cash on hand, and it can easily see through into the second half of 2027. It does have a very, I would say, a decent level of inside ownership, which is always encouraging to see. That institutional ownership is pretty good, although I don't buy too much into that. It's hardly ever a factor in how a stock does. But I kind of take more stock into the inside ownership and inside buying and selling, which has kind of improved quarter over quarter. And these guys are, they have pretty good reviews and a lot of investment optimism in terms of their R&D and their development. And one of the drugs that they're developing for T cell therapy, so that's using your immune system cells for cancer, to fight cancer, TSC 101 has moved through phase 1, and I think it's doing pretty good in phase 2. They're going back and making some fixes and getting production ready and commercial and got their commercial manufacturing process ready. If they're able to scale these couple of steps, and they can go into phase 3, which means that they should have regulatory approvals, FDA approval. At that point, history shows these companies tend to do pretty well. They get good traction. They usually end up making good revenue. And it's kind of a threshold. It's kind of a watershed moment if they can get past this. And investors are pretty optimistic about it. And their earlier results from phase 1 and phase 2 for TSC 101 have been pretty good. So again, it's the risk. It's an acceptable risk. And since it is still in the aspirational stage, right? It's not like Akebia Therapeutics, which is much down the life stage, and it's making some pretty decent $200 million of revenue a year. These guys are still at the aspirational stage, and usually in that stage, the upside can be very high as well. That's kind of the market and traders playing their games as well. But interestingly, it has a very high target by analysts, which, I think $6 is probably too high. But if it comes through with these catalysts, the results from their phase two, as well as if they can enter phase three, it should be a pretty significant upside. I wouldn't be surprised if it touches 2.5 from here, maybe even $3, depending on how the results go. And then again, the idea is that if it doesn't pan out the way we would like it to, and let's say they hit some snags, which can always happen, they don't move into phase three like they want to, and their TSC 101 fixes that they need to do to get their production process ready doesn't work out. So if there's negative catalysts, hopefully the downside ain't that bad from these levels. Again, you can see that it is at an all-time low. And if things don't go your way, maybe you can sell out at, I don't know, 80 cents a share or something like that. So that's kind of it. And if you're diversified, you hold a couple of stocks like these, gives you a little bit of diversification as well, although it's not the level of diversification I think that we would like. But since we're still mostly held in cash, kind of doing a wait and see on how the AI race pans out and how energy moves forward, and if BEVs come back or not, and what goes on with quantum computers. These two seem like decent plays, so we'll see how they pan out over the next few months. Okay, so I'll wrap it there. There's definitely a ton of stuff that I can just keep rambling on about, but yeah, I think well, I guess I'll stop here. Okay, so I'll follow up with you guys one on one, which is what I've been doing over the past few months or so, and we'll see where this goes. All right, guys, take care. Bye.